Okay, for this week, we're going to start with covering some economic data for the week. We have jobs and CPI. We'll look at rates and yields, which includes our real rates, break-even rates, OAS. And we're going to take a closer look at some housing data because within economic data, within CPI, there were some crying foul about owner's equivalent rent. So we'll see if any housing data can tell us what's going on with pricing. We'll look at Realtor.com. We'll look at Lennar and KB Homes because they reported earnings, and they do talk about their average selling price. Look at how SPY finished, and our spotlight company is Axalta, which is in the coatings segment of specialty chemicals. This will be the last company spotlight I do for 2025 because next Sunday is December 28th. I will do my themes for 2026, what I think the big macro themes are. And from those big macro themes, we can decide what plays and what sectors we want to be in. I did this last year, and my number one and number two was weaker U.S. dollar. Stronger at the beginning of the year, then weaker. And we are going to see that we're down almost 10%, 9% on the U.S. dollar year to date. And the other big theme I had for 2025 was volatility everywhere. We certainly had that. I've got a couple of really big ones for next year. The big one is the two big ones, I think you know what they're going to be. One is relating to AI and how AI will unfold over 2026. And the other is central bank and how that will unfold over 2026. And I don't think there's any secret there what I think is going to happen. Anyways, let's head on in. But before you do, can you just click on that like button? Yeah, I always say click on the like and subscribe, but you don't have to subscribe if you don't want to. But click on the like button. It really helps the algorithm, which helps me out. Let's go. Well, let's start this week with looking at the economic data from last week. At the beginning of the week, we got inflation data for Canada. If we look at the year over year, and we have November, Canada didn't have a shutdown, so we have good data or consistent data. Why don't we say that? 2.2, same as the month before, 2.2. Expectation was for 2.4, so that was pretty good. The core year over year, 2.9. Last reading was 2.9, unchanged. The month over month has got some nice drops to it. If we look at the headline inflation rate, the expectation is 0.1, came in at 0.1, last reading was 0.2. But look at this. This is the core for November, month over month, negative 0.1. The month before was 0.6. Let's move over to the U.S. non-farm payrolls. We got November and we got October. The average was negative 20,000 per month. November showed a gain of 64. October showed a loss of 105. A lot of government workers here. So we may be eager to dismiss it, saying, oh, well, it's government workers. Doesn't matter. As far as aggregate demand, if you separate somebody from their paycheck, you lose aggregate demand. These are people who were receiving a paycheck, and the government is operating in a budget deficit to begin with. So this is just separating people from their paychecks. It does matter for aggregate demand. Let's take a closer look at the 64,000 from the establishment survey. 64,000. Government was negative 5. Private added 69. Healthcare was 64 of that. I compare healthcare to maintenance capex. There is growth capex and maintenance capex. Maintenance capex is the money you got to spend just to maintain the productive assets of your business, the productive assets of an economy, or labor and capital. This is just maintaining the productive capacity of labor. It doesn't really add, it just maintains. And it is a function of the age of the population more than it is the productive capacity of the population. So I look at those and I say, well, they would have been added anyways, right? The other side of it is it doesn't matter. It's still 64,000 more people with a paycheck, right? We had some revisions as well. August came in at negative 4,000, is now negative 26,000. September 119 is now 108. Average weekly hours up by 0.1. Average hourly earnings, that is really low, 0.135. Is 1.65% annualized. Just to put that in perspective, CPI year over year came in at 2.9. So wages are underperforming CPI. Average weekly earnings, 0.429, which is 5.27% annualized. So, okay, you're working an extra 0.1 in hours and getting paid a little bit more. So collectively, your take-home pay is now beating inflation, but you do have to work more hours to get that. Let's look at the household. And we don't have October, but we can look at the difference between September and November. This is a 2-month difference. Employed increased by 96,000 over those 2 months. So that is an average of 48,000 a month. Kind of matches the number we're getting in healthcare. Labor force increased by 323,000. U3, that is the unemployment rate that is published, came in at 4.6. U6, the broadest definition of unemployment, came in at 8.7. The difference between these two is the widest in the last 12 months. I don't know if it's the widest in the last 24, 36, or whatever. I just know, looking at the report that I looked at, you could look back over the last 12 months. So right away I could see, oh, the last 12 months it was the widest. I would have had to go back and open up other older reports to look at the spread between them, and well, I think it's enough to say, hey, it's the widest. Participation rate increased by 0.1. So when you have very little job creation and a participation rate increasing, you will get a higher unemployment rate. You can make that unemployment rate 7% very easily by increasing the participation rate from 65% to 68% without any job creation. Just a whole bunch of people saying, I'm looking for a job, and the unemployment rate will go up. You can also get the unemployment rate down by just discouraging people and saying, well, why even look for a job? Why not just drop out of the labor force altogether, right? High school has lost jobs. Less than high school lost jobs. High school up 921, less than BA negative 333, and BA plus negative 364. Look at this, the shift from full-time to part-time. Full-time lost almost 1 million, part-time gained almost 1 million. The other big data report we got was inflation for November. There was data collection, but it started later in the month than normal. Year over year, 2.6%. The expectation was 3%, and this was the core. And headline 2.7. The expectation was for 3.1. So when it came out, my initial reaction was, "Whoa, those are big numbers." But there is some data collection issues with this. We can see here seasonally adjusted changes from the preceding month. October, you have nothing because there was no data to be collected. So even if you did collect data in November, you could not enter in the preceding change from the previous month because October had no data. So for November, the problem there is not that there was no data. There was no October data. So November data collection did resume on November 14th. The report did tell you that. And some people pointed out, well, that's a timing issue then, because the data is being collected later in November when discounting at retail stores increases, so that there's more discounting, so you might not be seeing the true price. Also, there were pointed out some issues in owner's equivalent rent. that the drop in owner's equivalent rent could not be explained. It was out of the ordinary, and it must be that because you're zero lining, you're just moving forward some numbers. So we're going to look at some real estate data and look at some two companies reported earnings in the housing sector, Lennar and KB Homes, and what they say for the quarter about average selling prices and pricing pressure, to see, is it possible that housing is dropping off more rapidly at this point? And the data say, well, yeah, that's exactly what's going on. So I don't know that I would say, oh, this is going to reverse at some point. I don't know about that. Supercore, 2.3% year over year. I also have it calculated down here, 0.141. This is the September to November period. That's a 2-month period. So if you're annualizing it, you're using a power of 6, not 12. 0.85% annualized. Housing 0.359 or 0.217% annualized. The data from Realtor.com, from Zillow, from Lennar, from KB Homes disagrees with that entirely. They have negative numbers. So housing to be there, this is the problem when it's survey based and you're path dependent upon a certain number that you think you're going to get for rent without revisiting the price of your home realistically. 2.17, and housing is not up 2.17% year over year. On a national basis, it is down 1%. 1% down, not up 2.17. Headline, September to November, 0.204. That's 1.23% annualized. If you look at the non-seasonally adjusted, it is negative 0.208. Negative. Okay, let's see what effect that data had on markets, and just let's keep in mind what we looked at. We saw negative revisions to jobs for August and September, an average of negative 20,000 jobs for October and November. November positive, but all the jobs pretty much going to healthcare. For inflation, we came in on a year-over-year basis lower than expected, but of course there were some issues with data collection and with some imputed values. So what was good news for the bond market, I had said this on the pre-market live event for Thursday, that it wouldn't surprise me if the bond market talked itself out of all good news. Oh, it's not that good. In fact, it's terrible. And no matter what the news was on the equity side, especially for the jobs side, the market will talk itself out of that as well. Oh, it's not that bad, and there we go. And that's exactly what happened. Is the any good news in the market went to the equity market. Any bad news in the market went to the bond market. Buy the dip in equities, sell the rips in bonds. Has worked for 2 years, continues to work. We don't actually fix anything. The market collectively just talks itself out of things. Long end of the curve, down just a little. But it felt like it was much worse because it was so much better during the week, and then you watch the market just give it all back. Now, some of this has to do with the Bank of Japan raising rates and the long end of their curve going up. If that's repricing, it tends to reprice, at least psychologically, everything else. So some of that had to do with that, because Thursday night TLT took a big drop down in overnight trading. Slopes basically unchanged, and let's look at the effect on certain equities. KRE still outperforming. SPY was down 0.17. Banking index, regional banking index up 0.24. Dollar had a somewhat okay week. Still year to date down 9.07%. We're coming in to the end of the year. That is a pretty poor performance for the dollar over the course of the year. IYR flat for the year basically. All you are walking away with is your dividend. Gave back 1.84. Pretty much gave back all its gains for the year in 1 week. XLP almost flat for the year. Again, walking away with just the dividend. These are considered safe plays. This is a defensive sector. This is an interest rate sensitive sector. And we can see on the long end of the curve from the beginning of the year, the 30 years actually higher. The 20 years only down 9 basis points. And these are very long duration assets, perpetual horizons. So we can see, given what we have on the long end of the curve, that we shouldn't really expect too much there. In fact, these should pretty much mirror where TLT is. TLT 0.25 for the year, XLP 0.22, all right in the same area. If you have a reason to really love TLT at this point, I've completely given up now. I've gotten out of my TLT shares and moved into bonds, and I closed all my TLT options and said that's enough of that. So I am leaving the TLT trade before the end of this year. If you have some reason to really love TLT, you have to love these guys as well. SPY 16% so far year to date. Add that 1% on for yield, you're 17%. They gave back a little last week. IWM down 1.21, but still pulling out a good performance for the year. And Triple Q being the big winner here, up over 20%. Let's see if it holds that into the end of the year. My forecast going into the end of 2026 is unchanged. None of the activity and none of the data changes any belief I have that we're heading to 2% by the end of 2026. The pick, Trump's pick, will not be Powell or Powell-ish, will not be rational. It will be, let's get to 2% and then let's get rational. We'll use our balance sheet and we'll use our relationship with the Treasury to manage everything else, but let's get the short rate to 2%. Everything else could be managed with open market operations. So let's do this first. I think they're going to get there very quickly. I do believe that Besant is highly motivated because year one is done. He's going into year two. He had a 3-3-3 policy, 3% real GDP growth, 3 million extra barrels of oil per day, and a 3% 10-year. That was his 3-3-3 plan. So I do think he is motivated to get it to the 3 to 3.5% range. So that is where I'm going to put it. Slopes will increase on both the capital market curve and the money market to capital market curve, and that would put December ZQ in around 97.83 to 98. We're sitting at 96. Where's the December ZQ? 96.95 right now. So we got quite a ways to go. Let's look at what the market is pricing in terms of rate cuts. Q1 of next year, 16 basis points, waffling on whether or not it'll even be a basis point cut, or a cut from the Fed. 3 meetings left with Powell. I think he would like to get closer to neutral before he hands it over, saying, look, I did my part. I can see that being a 25. I just can't see it being more than 25. I wouldn't put, unless the economic data really falls apart and inflation really drops and gives him permission, I can't see more than one cut. I see one cut. I think one cut is not unrealistic. Q2, one cut in Q2, and there is one meeting, not even one cut, and there's one meeting. Where are we here? Q2 is here. This is one meeting with the new guy. You're telling me that of the June, July, and September, for those 3, you're going to get maybe one cut. Trump will go ballistic. Q3, not even a cut. Q4, forget it. 60 basis points. And I do think you're going to get one in Q1, which leaves Trump's new guy 5 meetings, and you'll get 1.5. Think about that. You got 5x Powell. I have my position solidified here. For the October ZQ, I have 342 contracts. My December position is 50 contracts. My April is 60, and my May is 48. That gives me the 500 contracts that I wanted. Even going out to April 2027, that's 11 meetings. 10 meetings. 10 meetings. 7 of them without Powell. 59.5 basis points. Fewer than what you have here. Call it even, basically. Call it a rounding error just because of the way it closes. So what this is saying is that by the end of 2026, all the way to April, you're going to get no more cuts. This is just going to 3% and then flatlining at 3%, saying, well, that's neutral. That's where we're going to stay. Nobody knows what neutral is, but somehow the market's coalescing on 3%. So you want them to coalesce on 2%, start the conversation saying, neutral is really 2%. It's really just 2%, and the market will hey, everybody hear this? It's 2%. The crowd will shuffle all over to 2% and start repeating it as if it's gospel. It's 2%. The neutral rate's 2%. You got to get to the neutral rate. Neutral rate's 2%. And hopefully if you can change the narrative, then the market will talk itself into something else. It doesn't have to be true. It just has to be widely believed. I'm still with Warsh as his pick. Probably with Besant still at the Treasury, although I still hold out a little bit of possibility that Besant moves over to the Fed and somebody else goes to the Treasury, and you have this tight alignment between the Fed and the Treasury. I don't know why, but Wall Street, I keep hearing, Wall Street would like it if Besant was there. Wall Street, he's the adult in the room. It's a race between him and Rubio about who can get their head furthest up Trump's ass. I don't know if you ever listen to Besant speak, but all you hear is Trump's voice when he speaks. But I think the market, to get back to the topic, is absolutely mispricing this thing. That if I only had one bet next year, and I could only make one bet and put everything on one number, this would be it. I'd put everything on ZQ. Because at the price of ZQ right now, pricing in only 60 basis points of cuts to the end of next year, I don't see where my downside is. Somebody help me out here. Where is my downside going to be when you have 5 meetings next year with Trump's new guy, and we're talking 60, trying to squeeze out just 60 basis points, and if you do get 2 cuts, your downside is so minimal at this point, so minimal. Okay, let's have a look at real yields. Let's look at our 10-year down 1 basis point, which is lower real yields are bullish for gold, down 32. Remember, we had a stronger dollar, which is negative for gold, lower real yield, slightly lower, which is positive for gold. Gold doesn't care, up 0.93. Silver, look at this thing, 8.67%. Copper up strongly, 2.9%, up 31% for the year. Aluminum up 15% for the year. The metals just killing it. Energy, on the other hand, going the opposite way. West Texas down again, down 21% for the year. This is a benefit for American consumers. Tariffs take away their income because it is a tax, but lower gas prices give it back at the pump. So it's sort of a nice little neutral there. It's a way to get the higher gas price in the form of a tariff, give you a low gas price, but you'll still pay the higher gas price because now you're paying a tariff on other things. Natural gas down 2.67, up 10% for the year. This is a tough one to play. And the food inputs, wheat, corn, and soy. Wheat down 18% on the year. Corn down 10%. Soy almost flat for the year. Looks like China's not going to buy what it said it's going to buy. They lied? Where did they ever get the example of lying from? What world leader ever showed them how to do that? Break-evens slightly lower as well, consistent with the inflation report that we saw before the market talked itself out of any good news. And corporate spreads all increasing. A rare week in which we see corporate spreads all increasing. The mortgage-backed security ETF up 0.08. Look at agency and annually here. For the year, 24% price on annually, along with the 12% dividend, 36%. Beats the NASDAQ, beats the S&P, beats small caps. Even agency, you're running around 29% total return, easily beating the NASDAQ. Two sleepy little mortgage REITs beating the broad equity indexes. Going into the FOMC for January, no cuts, 75%, now is almost 78%. After what we saw, after the employment report, it's not that bad. After the inflation report, it's not that good. We're talking ourselves out of rate cuts. And to get one rate cut, probability dropped to 22%. Powell's last stand, this is his last meeting. This is the third FOMC meeting of the year. This is the distribution. We did have some weight on 75, 3 cuts. I think that's ridiculous. So it is now 0, which I think is right. There was some hope there. But I think that would have been just stupid and ridiculous. 2 cuts. Not out of the realm of possibility if the data doesn't start turning around. 2 cuts. 9.5% down from 17%. This is the more likely here. 43% is now 47%. So there is more weight coalescing on at least one rate cut in those first 3. That would mean December ZQ only needs 1.5 rate cuts in 5 meetings under Powell's new guy. Under Trump's new guy, I want you just to think about how mispriced that is. And no cuts at all. There was 37%, now up to 43%. Let's look at some other stats here. Reverse repo, $3 billion. It's bouncing just between 1 billion and 3 to 4 billion now. I don't know that this is very interesting to watch anymore. Repos are 0. Reserves, 2.9 trillion. The TGA sitting at 861 billion. Fed governor projection for 2026. This is the median projection here, 3.375. By the way, that is only one interest rate cut from where we are now, 3.64. That is one interest rate cut. The FOMC sees one cut. The market being more aggressive says, oh no, there'll be 2. Trump saying, yeah, right. Mortgage, 6.21, the 30-year mortgage. We got the National Association of Home Builders Sentiment Index for November, 39. Last reading was 38, so okay, but it's a diffusion index, so anything under 50 is still shrinking. So it's less activity than the month before, but not as less activity than the month before's month before, if you can follow that logic. Mortgage apps down 3.8%. We're also at the low season for housing sales. Once you get into December and January, the Christmas season, very few closings. People don't want to leave their home before Christmas or move in that period of time. It usually drops down. December, January, February are the lows of the season. Then it starts building up into late February, March, April. The spring is the busiest season, down 3.8%. That's not surprising. Existing home sales for November up 0.5. Here, let's take some time and look at some of the housing data we have and ask ourselves, is it so unrealistic that you had a negative 0.1% imputed value on owner's equivalent rent over that 2-month period? Is it so unrealistic? For that, we're going to need some data from some housing companies that reported, and then some national data, and we'll get that from National Association of Realtors. Why don't we start there? Okay, I'm on Realtor.com, November 2025 monthly housing market trends report. We're just going to look at a few screens here. Active listing counts up 12.6% year over year. All the years below it, all of these lines here is post-pandemic, and all of these are pre-pandemic. 2017 is blue, orange is 2018, the red is 2019. Here we are, November 2025. We can see active listings reapproaching the area it was in before the pandemic. Let's just go down to pricing. Here we are. The brown line is up here, November 2025. Median 415, down 0.4% year over year. But that's a median of all the homes that are listed. You can't really control for size, which it does down here. Regional list price patterns overall versus per square foot. So this is overall. Northeast flat, Midwest up 1.7, the South down 1.3, the West down 1.5. But if you control for price per square foot, Northeast, even though the median price shows 0 per square foot, up 3.9%. Midwest 1.7, 1.7. South 1.3, but per square foot down 1.9. More pricing pressure there. West down 1.5, but per square foot down 1.6. And price cuts up 1.3 percentage points year over year. 18% of listings now offered at a discount. Northeast 12.8% of listings. Midwest 18.2, the South 19.1, the West 18.5. You can see here the higher you go, the more reductions there are. And there's only 2 years above you, and it is 2018 and 2022 at this point in time. 18% of listings have had a price reduction. That's an increase of 1.3% year over year. We'll look at Lennar and KB Homes. For this, I just used Perplexity. You can see the prompt that I used. Let's go right to home prices. Average sale price fell to $386,000, with management noting they are pricing homes to market conditions. Now, these are new home builders, so they're not sentimental about the value of the home. They're concerned about cash management, so they're willing to discount to the market to move properties. Existing home sales, not so much, but we did see existing home sales average, or the median price, down year over year. Pricing homes to market conditions and implementing 10% price cuts in some communities. 10%. Oof. To stimulate demand, CEO Stuart Miller admitted softer pricing is necessary to clear inventory, expecting stabilization in 2026. Incentives rose significantly, gross margins dropping to 17%, including rate buydowns and discounts, as Lennar reduced construction costs by 5% year over year, but prioritized volume over margins to maintain new orders. Let's go to KB Homes. Home prices. Average selling price dropped 7% year over year to $465,000. Lennar is more national. KB Homes is more concentrated in the Southwest, primarily California. 7% year over year to $465,000. Full year ASP slightly down to $481,400. So that's a linear drop. How you get there is take the $465,600, multiply by 1.07. You'll get the price last year, divided by 2. Because if you had a nice linear slope on the way down throughout the year, you should be able to take the average for the year, which is $481,400. You should get close to that average. So $465,600 divided by 1.07. Take the difference divided by 2 and add it back to the $465,000. You get $481,000. Nice linear slide down. So the difference between those two numbers, full year ASP, is for everything we sold last year, the average selling price was $481,000. However, at the end of the year, if we look at last year, it's down 7%. Management cited pricing pressure and geographic mix shifts as homes delivered fell 9%. Housing gross profit margin compressed 17% from prior highs, driven by price reductions, higher land costs, elevated incentives like rate buy-downs to offset high mortgage rates and boost net orders. So Lennar, lower average selling price. KB Homes, lower average selling price, 7% year over year. And Realtor.com for individuals selling their own home, down 0.4% year over year. The home builders will be closer to market reality because they're not sentimental about the homes they build. They build these homes. There's a certain amount of margin in there. They're more concerned about cash management. Let's move these homes. Let's sell these homes. Whereas the individual who owns one home is a little bit more sentimental. Will have a certain price, and as we've seen, 18% of them have said, okay, I guess we got to lower our price. They're just not lowering it enough based on what new home builders are doing. The true price, the true market clearing price for existing home sales is somewhat lower than where it is now. One of the things we have to be aware of on Realtor.com is those are not sold homes, those are listed homes. What Lennar and KB are telling us on their selling price are the homes that sold. For the ones that are listed on Realtor.com, those are the ones that have not sold. Those are just listed homes. And the listing price, 18% of them had to drop their price, and the listing price, the median listing price is down 0.4. That does not mean that's the price they're going to sell at. And we can see that with inventory rising, inventory is almost in the same area as pre-pandemic levels. That with the inventories rising, those prices are still too high. So I don't know that we would say that owner's equivalent rent coming down is such a shock, or coming down quickly is such a shock, when we can see evidence of this in home builders, and we can see evidence of this at Realtor.com. Okay, SPY almost got to flat week over week, still down below its all-time high, which we saw on December 10th, down 1.15%. The forward four-quarter operating earnings down from last week. We're at 298.91, closing SPX 68.34, pushing back up to 23. So that we can start hand-wringing again once we get over 23 and start talking about bubbles everywhere and overvaluation. Till we get to 22.5, then we talk about, is it time to buy the dip? Till we get to 23.4, then we say, is this a bubble? Are we out over our skis? Till we get back down to 22.5 and say, is it time to buy the dip? And rinse and repeat, and rinse and repeat, and on it goes. And even volatility is getting bored with the whole thing, saying, wake me up when you figure out what's going on. Second percentile in the last 13 weeks. Volatility just almost disappearing to zero, saying, it's the least amount of risk to price in the last 13 weeks. 2%. IWM down about 3% from the high it set on December 11th. Triple Qs, this is a still late October high, has not taken it out. 3%. You had the small caps and S&P taking out their October highs, but Triple Q failing to do that. And IJR has still failed to beat its all-time high. I rely on LSEG to tell me if there are earnings. Last week it said there are 0 companies reporting earnings. That was a lie. There were companies reporting earnings. This week it's saying 0 companies, but in LSEG's defense, it's only really talking about the S&P 500 components. It's saying 0 S&P 500 components are reporting this week. So there we go. All I can do is work with the data that is given to me, and we know how difficult it is to get an earnings calendar, something that companies blatantly tell you. And you're going to aggregate something they blatantly tell you. How? I mean, you can't do that, right? Our spotlight company this week, Axalta, in the chemicals sub-industry, coatings and paints. No paints, coatings are what they do. This is an odd one compared to the ones we've been doing before, because I'll tell you right now, there is absolutely no reason to ever own this thing. I don't know why you would. It is a perpetual underperformer. You may go through this company and through the sub-industry and learn about this, look at its numbers and say, why would I ever invest in this? What a waste of time this was. Nothing is ever a waste of time. I want you to think about sport hunting versus communities that do it for their livelihood. Northern communities that hunt and trap as a livelihood versus a sport hunter. A sport hunter is looking for a trophy, whereas the other use every part of the kill. It is for survival. It is their livelihood. While they're doing it, they may bag a few trophies, but that's not the goal. The goal is to earn a living. Trading is very much the same way. You have some out there that are just looking for the 10-bagger. They're looking for the trophy kill. They're not going to tell you about all the losers they had. They're just going to point to that one big winner. Much like when you go over to a trophy hunter's house, he's got that one or two big trophies on the wall. He's not going to tell you about the thousands and thousands of dollars he spent on hunting trips that led to absolutely nothing. He's going to show those two big ones. Where somebody who makes a living doesn't need trophies. You probably won't find any trophies in their house at all, because this is a business for them. Same thing for us. This is a business. So what was the purpose of Axalta? I'm going to show you how even a company like this, where there is no reason to invest in it whatsoever, has a whole bunch of good information that we can use. We use every part of the kill. So let's go through what this company does, and it is boring for the most part. Its stock performance is a big yawn. It is a perpetual underperformer. There is no reason why you would ever own this thing under any market condition, ever. It's not defensive. In fact, it's more cyclical than the cyclical industry that it serves, which is automotive. It will suffer more than its customers will, and it doesn't celebrate as much as its customers do when things are great. So you look at all of the characteristics of this thing and you say, but why even have it publicly traded? Like, who would ever invest in this thing? We have institutional ownership at 98%. We got to make some sense of this. So let's have a look at what's going on here. The big deal on November 18th, this is the big deal here, is that you have an all-stock merger with AkzoNobel, which is a European company. Shareholders of Axalta will get 0.6539 shares of AkzoNobel for each share they have. And after the merger, AkzoNobel will own 55% of the merged company, and Axalta will own 45%. The expected close late 2026, early 2027. So there's still a lot of things that can go wrong with this. There was a attempted takeover of AkzoNobel before, attempted merger. It didn't work out. So here we are. They're in different markets, so that sort of makes sense. They're not overlapping. Combined 2024 revenue, if you look at if they are combined now, the combined revenue was 17 billion, free cash flow of 1.5 billion. They expect to realize $600 million in synergies, with 90% of that coming in year 1 to year 3. Synergies are rather elusive. And both companies have suspended their share buybacks. Axalta does not pay a dividend. on their last conference call, they were specifically asked if the board is going to consider a dividend. And their answer was, given our share price, given where our share price is, we can't think of a better source of or a better use of our cash than to buy back our own stock. So rather than the dividend, they had share buybacks going on. All share buybacks have now been suspended. Let's look at Axalta's performance versus the S&P. Let me get a color that contrasts better here. Something bright versus S&P. We'll look at year to date, 3 years, 5 years, and 10 years. Year to date, AXTA is down 6%. S&P is up 17.49%. This is total return, by the way, not just price return, total return. So this 17.49 includes the dividend that SPY gives. Over 3 years, you'd be up 25% with AXTA, but 85% with SPY. What about a 5-year period? You'd be up 10% versus 97%. Over a 10-year period, 25%, pretty much dead money, right? 24% versus 300% with SPY. If we take recessionary periods, SPY outperforms. If you take rolling 2-year periods, SPY outperforms. Rolling 3-year periods, SPY outperforms. AXTA underperforms in almost every single market. So you look at this thing, you say, I can't find a reason why I'd ever want to own this thing. So we would expect very, very little retail ownership. And we have very little retail ownership. Institutional ownership, 98%. And I've had this thrown at me before. Yeah, if it's such a bad company, how come institutions own so much of it? Because that's what people sound like when they ask stupid questions. It's because it's in an index. Period. This is in the S&P 400. It's in the Dow Jones Mid-Cap Index. It's in the Basic Materials Index. It's in the Chemicals Index, Specialty Chemicals Index. It's in a lot of indexes. Well, if it's in an index, you need an ETF, because you can't trade an index. You need a tradable product. That's usually an ETF is created to track the index. When you buy the ETF for the chemicals sub-industry, you are buying everything. So money goes into this no matter what. Well, it's the sponsor that owns the stock. So it's institutional ownership. Maybe retail ownership of the ETF, but it's institutional ownership of the stock. So because it has 98% institutional ownership, that's saying that no one's really buying this thing except within ETFs that track an index. It just happens to be in a lot of indexes. That's all. I have the question here, why bother? There is a use for this. There's a very good use for this one. If you are long companies like GM, this is a nice hedge. Look at its price. Its price doesn't really move that much. $32. 52-week high, 38. 52-week low of 26. You're $6 above the low. You're $6 above the high. You're right in the middle of it all. PE of 15. Not a very growthy stock altogether. But we can get a lot of really good information out of this. When we're going through a company, we want to learn as much about the industry and the sub-industry that the company is in, because we want to spot or be able to see certain things or spot certain things that might be opportunities somewhere else. Not only that, this one provides us with some pretty good information about pricing. We just went through housing. We saw some pricing information there. If we listen, we're going to listen to one part of its conference call where it talks about pricing pressure in some of the markets it's in, and 2 of the markets that it's in, which are categories of CPI. So we can start to get some indication of where the market is. And then these companies are in their market. They're in their game. They feel these prices. And so it's, I think, better information coming from these companies. Let's see what we have. We'll start here. This is a graphic that you get very early in Axalta's 10Q and 10K, which gives you a very high-level overview of the segments it operates in, or that it reports under. We have performance coatings and mobility coatings. The end markets it serves and the focus areas. Two segments: performance coatings, 65.5% of sales. Mobility is 34.5% of sales. Mobility is light vehicle and commercial vehicle, which falls under automotive. And under performance coatings, we have refinish and industrials. Refinish, we're going to classify in automotives. This is body shop work. Your car gets into an accident, it needs to be fixed, and then some parts need to be repainted. So 76% of the revenues come from automotive segment. OEMs 34.5%, refinish 41%. That's what we get to, the 76%. The breakdown is 55% to 45% within automotive, refinish to OEM. OEM is very cyclical. So the sales for Axalta will be more cyclical than OEM sales will be. But refinish is less cyclical because it is paid for by insurance. So most individuals are insensitive to the price of the refinish, but insurance companies are sensitive to the price of refinish, and we did see insurance rates go up for quite some time. So the pricing ability within coatings will have something to say about the pricing of insurance. And that question was specifically asked on the conference call, and the answer is very insightful in terms of the pressure, or what kind of pressure we would see on pricing going forward for the category of automotive repair, number one, and number two, insurance. 41% of the total revenue of the company comes from refinish. Body shops, independent shops, multi-shop operators like vehicle dealerships, our company-owned stores in EMEA and Central America. For light vehicle, it's automotive light vehicle OEMs and automotive plastic suppliers, and commercial vehicles, heavy-duty truck, medium-duty, bus, rail, motorcycle. Small category in industrial, shouldn't say small, quarter of the revenue, 24.5%. Building products, construction, battery solutions. So you can think about coatings around cables, transportation, general metal finishing. And geographically, North America, 39%. The other big market is Europe, Middle East, and Africa, 40%. With the rest being split between Latin America and Asia Pacific. Total sales, this is their 10K. This is 2024. We're in fiscal year 2025. We just had third quarter earnings September 30th. Last year, 5.276 million, or 5.3 billion roughly, with about 400 million in net income. I had written a PDF for the coatings and paintings segment of specialty chemicals. It's up on the site in the applied series under industrials, in the industrial sector. It's interesting for the first 3 to 4 sections, and then it gets really boring because, well, it's not an exciting segment at all. A couple of interesting things to find. Coatings and industry. This is section 2, product segment and end markets. Two big ones here: architectural coatings and industrial coatings. And the big segment in industrial coatings, which we find our company, is automotive coatings. And two segments here, we have the OEM and the refinish, which we just saw on the previous screen. In architectural coating, who do you think the big player is there? 45 to 50% global revenue, 80 billion, with the remainder coming from industrial. Who do you think the big player is in architectural coating? This is for houses, right? Professional channel and do-it-yourself channel, the homeowner versus the contractor. Sherwin-Williams, the big player over there. Let's look at automotive coatings. We have OEM and refinish. And we'll look down here specifically under segment economics comparison. Aerospace and auto refinish, highest margin profile. Growth rates, high single digit. And cyclicality is defensive. The refinish part is defensive. Remember, they have 76% that comes from just automotive coatings. 75.5% from automotive coatings, and it breaks down as 45 and 55. So 55% of that is somewhat defensive, 45% is highly cyclical. We see it down here. Lowest margin profile, tends to grow with vehicle production. for cyclicality has the highest volatility, because when production drops, the volume that Axalta sells drops by a significant amount, because it's all they have is just coatings for OEM. So I have a good idea what happens downstream. We have a large segment, 41% of revenues in the refinish category, where the key customer really is the insurance company. And then we have 25% of our revenue coming from the OEMs, which makes the company's revenues more cyclical than OEM revenue is. Next, we move upstream and say, well, where are they getting their supplies from? Is there a key ingredient? If there is a key ingredient, who supplies it? Is it very concentrated, or are there many suppliers? So this is from section 3, raw materials formulation, cost structure and coatings, the anatomy of coatings and the raw materials. And from there you can get the cost structure and margin architecture, along with the ability to pass through any costs for raw materials. It doesn't take long before you bump into titanium dioxide. It represents about 40 to 50% of the cost of goods sold of coating companies, of paints and coating companies. Unmatched opacity and brightness, no viable substitute, inelastic demand. So that means no matter what price you have to buy it. So when I read that, my mind right away says, whoa, stop right here. Who are the suppliers of this? That's going to be interesting. Because if it's one or two really big suppliers, and especially if they're concentrated in China, that's a big problem. Well, Japan is the bigger supplier of this. And there are enough suppliers that it's not going to be an issue. It is concentrated. I think the top 10 make up like 45% of all the supply. But it is not the case such that there's this concentrated supply where if something happens in China-US trade talks, where this company is an obvious short target, or where there is one or two big key suppliers, and if one of those suppliers goes offline, the price of this stuff goes straight up. Everyone downstream is a short target. So I don't have to worry about that, but we do have to, if we're going to be concerned about this company and its cost structure, have an eye towards the pricing of titanium dioxide. But it's not enough, there's not enough concentration here for me to be too concerned about it. Another section I had done, section 6, financial analysis and valuation considerations, gives you margin profiles and profitabilities for typical specialty companies, the capital intensity, assets and working capital, cash conversion cycles, allocation segments, valuation methodologies. I went through quite a few of these with the company, and they fall pretty much in the middle of the range of everything that's going on. So there's nothing really outstanding about this particular company on any of these metrics. Okay, I want to take you through just a little bit of their Q3 2025 presentation. This was for the quarter ended September 30th. And then we'll listen to a segment of the conference call where they're specifically talking about some pricing. Now keep in mind, they're $32 a share. Sitting in the middle part of the 52-week low to 52-week high. Certainly not at the lows, but certainly not at the highs. 15 times forward earnings, 98% institutional ownership, sort of a big yawn from where they are. But let's see how they're doing. Maybe their results are a big yawn as well. Third quarter highlights, $1.3 billion in net sales, $294 adjusted EBITDA, 22.8% adjusted EBITDA margin, which is pretty good. They have a program in place to try to get all of their margins at a minimum of 21%. Adjusted diluted EPS change year over year plus 6%. 12 consecutive quarters of adjusted diluted EPS growth year over year. 12%. A record quarter for adjusted EBITDA. 12 consecutive quarters of growth year over year. You can see 70 basis points expansion in the margin year over year. Record quarter for adjusted diluted EPS, not just adjusted EBITDA. Third quarter record for mobility net sales. Expanded adjusted EBITDA margin in both segments. In mobility, up 230 points. Performance coatings up 20 points. Repurchased 100 million in shares. Lower share count. Net leverage ratio of 2.5 times. We have 6 quarters here of adjusted EBITDA margin above A-plan target. The A-plan target is 21%. 6 quarters in a row they've been able to get that. 60 million benefit from new mobility business in 2025. This is their year-to-date highlights. 90 million refinish growth from new wins. 15% reduction in interest expense. They have variable interest expense, so lower rates will benefit them. Industrial profitability exceeding A-plan targets. Operating expenses 5% lower. Look at all that. And yet, they're in the middle of their range. All of those records, all those quarters in a row, and just a big yawn on 15 times forward earnings. Here is their sales year over year. Volume down 4.2%. Price and mix down 0.3%. FX did something there. I don't consider that operational. I just consider that luck. So they're down 2.4% year over year for the quarter. So we can see here the percentage change. Net sales down 2%. Net income up 8% in their favor. That is pretty good. Let's look at performance coatings. This is where we'll find refinish. Down 7% year over year. Industrial down 4%. Adjusted EBITDA down 5%. And we have this nice breakdown from Q3 2024. Volume down 5.7%. Refinish HSD means high single digits. Industrial is MSD, mid single digits. High single digits for refinish. Price down 2.4%. They don't have pricing power here. Volumes are down and price is down. So you can always offset dropping volume by increasing price, but not here. And currency, they got lucky, 2.5% down 5.6%. This is the more resistant side of the business is down 7%. A combination of both volume and price. Let's look at mobility. Light vehicle up 7%. Commercial vehicle down 7%. It's a wash, right? Volume down 1.2%, but some pricing power here, 3.7%. And FX at 1.5, so you squeak out a bit of a gain in mobility. But this is their bigger market and the more resilient market. And we're seeing both volume decreases and pricing pressure. So obviously a question needs to be asked about this, and there was a question asked about that, and we'll listen to it shortly. We don't need this. Here's our guidance. Okay, what we have here, Q4 of 2025. Net sales will be negative year over year, mid-single digits. Adjusted EBITDA about 284. Adjusted diluted EPS about 60. Looking at what their prior guidance was and their current outlook, guiding net sales to 5.1 billion, below the lower end of their range. Also on free cash flow, 450 million, below the lower end of the range. Adjusted diluted EPS coming right in the middle, with adjusted EBITDA at the low part of the range. 2026 considerations: normalizing refinish claims environment in North America. And we do have a question that relates to this, along with the volume drop and the price, the lack of pricing power. And we'll listen to that as soon as we're done here. North America refinish destocking trend to abate. Stable light vehicle global production. Raw material costs to remain flat. Stable global production, not growing, just stable. Axalta well positioned for industry recovery. Refinish revenue expected to turn positive. I think what they mean is the growth in refinish revenue expected to turn positive beginning Q2 2026? Because I read that, I go, refinish revenue expected to turn positive. What do you mean revenue? You mean revenue growth? Somebody forgot the word growth. They're going to get fired. Continued net new body shop wins. Growth in refinish adjacencies. Strong price mix performance. Everyone guides to optimistic scenarios, don't they? Above industry growth in mobility. Accelerated capital deployment. Let's listen to the question that was asked and the answer provided. This gives us really good insight into CPI, because these are two big categories of CPI. Like I say, we try to use every part of the kill. When we go through this, we're looking for information not just about the company, but other things that come our way. And this sort of just came my way, and I heard this go, well, that's useful in another place.
Thank you. Our next question will come from John Roberts with Mizuho.
Thank you. Could you dive a little deeper into some of the underlying drivers in the refinish business? Auto accident rates, insurance inflation, overall repair costs. I mean, those are the things I think that caused the dip in the business. And what are you seeing in those drivers?
Sure, absolutely, John. Good morning. So first, as I look at accidents or collisions, I think nothing's changed. Accidents are still occurring. That's around. There's a slight decline. It's about down 1%, but overall accidents are, let's call it, flat to down 1%. If I look at claims, obviously, this is the big driver to what's driving the disconnect. And if I look at North America, that's down about high single digits. Europe is lower. It's, let's call it, in that mid-single digit range. And the primary driver here is exactly what happened and what we've talked about quarter over quarter, which is insurance premiums going up significantly and also consumers pulling back from just a sense of the confidence and the macro. And around this, I think what you can start getting a sense, and obviously we've spent a lot of time because the refinish business is such a large and very important part of Axalta. It's certainly something that we've watched carefully. And I think, the good news is when I look at insurance costs, as we said, if you look back to 24, insurance costs were going up almost, double digits. If I look at 25, you can start seeing insurance premiums starting to go flat. And that's an overall perspective for the United States. Actually, in 27 states, insurance costs are actually coming down quite a bit. And I would say overall, that would mean the other half of the states are going the wrong way. But overall, insurance rates are stable and starting to get flat. From repair cost perspective, what we're starting to notice is repair costs are also starting to get flat and go down 1%. Again, as volumes and backlogs start reducing at the body shops, you can start seeing that folks are starting to drive to balance this out. So that's one of the good perspectives that I think is driving a stable environment as I think of how we're preparing into 26. From a perspective of what we're seeing on the premium side, especially with costs of vehicles going up, as well as what's happening with used car pricing, you can certainly see that work is also starting to drive back. The leading indicators are starting to turn positive. And a perfect example of this is if you look at CarMax or Carvana, you can start seeing that their performance is also improving by 20%. So that's a great indicator. Those guys are also large customers of ours, and we can start seeing as cars are coming back from lease or being returned, those folks are also having to fix cars before they obviously try to sell them again. So I think the right market environment is starting to switch. Obviously, winter is also coming if I think about early next year. So I certainly believe 26 will be a different place as we start the year for refinish.
Okay, before we continue on, let's just recap what we just heard. We heard a discussion about insurance costs, automotive insurance costs, and automotive repair. These are two categories of CPI. the weighting on automotive insurance is about 2.8%. On repair, automotive repair is about 1.1%. 3.9%, roughly about 4% of CPI. We have very recent data on it, somewhat forward-looking. We can see, he says, the costs of insurance for 2025 are basically flat. That's a zero. Actually dropping in 27 states. As far as automotive repair, at least in the body shop side of it, with the backlog cleared out, these body shops are now competing for business. They're seeing that pricing is flat. That's a zero. We already heard from Lennar and KB Homes about housing pricing year over year, and it is down. One is local, more local to a particular region of the US. One is more national, but it is down year over year. And shelter makes up about 33% of CPI. And we're getting quarterly information with somewhat forward-looking numbers to them as well. So we can get a preview of CPI by extracting information from companies like this. So Axalta, although there's not much here to invest in, did give us a window into about 4% of CPI. Thank you for the free information. Here is a 5-year performance chart. Every company has this in every 10Q. Just before they get to the management discussion section, they present this to you. We can see in blue at the bottom, Axalta. The dotted line is the S&P 500. The green line is S&P 400 materials. Again, reinforcing what I said earlier, that there's really no reason to be here. If you like their prospects, if you like Axalta's prospects, being in the the S&P 400 materials sector is the better performer. So what would we ever use this company for? Its implied volatility is 31%. So that's not too bad. This, to me, seems like a nice target for short strangles. That if I want a zero delta trade, meaning that I'm going to have no delta, but I will have vega and theta, the short strangle makes a lot of sense because it doesn't really go down that much, but it doesn't really go up that much. It is a yawner of a stock. Be a nice little one to earn income on. If it's something that I felt that, let's say I'm long GM and I have my average cost of $45, it's $80. I think that we're going to be weak for a while. We could retrace to $70, but I'm certainly not going to sell it just to realize that big capital gain only to rebuy it at 70. I'm just trading dollars. After tax, I'd be indifferent between that. I may as well hold it, but I don't have to suffer. I could sell calls on GM if there was going to be a downturn in the automotive industry, let's say for 2 or 3 quarters. I could sell calls on GM to protect some of the downside. But what if GM really does perform as a company? It lays people off, it cuts costs, it still squeezes out its earnings. I run the risk of it being called away from me, but I do know that the coatings company is going to be a lot more volatile in an automotive turn down than any of the car companies will. So I can always protect my long position on GM by shorting this company and removing some part of the exposure of the industry, or by selling calls on this particular company. So it's not completely useless. It may have a use. So it would go on a screen called negative beta. That if I ever need to add negative beta, I want to do it in a way that sort of benefits me. I want weak stocks on there. This is more cyclical than the industry that it serves. So this is where I would sort of put this company here. It's not an investable company. I wouldn't tie money up in this thing. You probably could have done better by rolling over 3-month T-bills over the last 5 years. Actually, you could have done better by rolling over T-bills for the last 5 years than investing in this one. And that's the end of this one. This will be the last one I do for this year. where is it today? The 21. Yeah, next Sunday, I'm going to do, instead of a company, I'm going to do a preview for the year ahead. Big macro themes of what I think 2026, or the big themes of 2026 will be. And that is it for this week. Everybody, have a Merry Christmas, or if that doesn't apply to you, Happy Holidays. And if that doesn't apply to you either, have a great week.